I have not been this excited about a stock or an ETF in an extremely long time. Today's ticker is ticker SPYI. This is the NEOS S&P 500 High Income ETF, and we are going to run the numbers and see how many shares and how much money you have to put into this stock to make $500 a month and $6,000 every single year, which is insane. And I'll be honest, right off the bat, I know the number and it is much less than I was expecting, which I love to see. Now, this income ETF is focused on that monthly dividend income, so price appreciation is something that I usually overlook with these funds. The problem with that is with funds like QYLD and JEPI, XYLD, funds that I actually did own in the past, is their stock price dropped. So you still were losing money in the stock price going down, where SPYI has been performing really, really well. So we're going to look at a couple things. We're going to compare the dividend history with some of these other popular funds, and then we're going to look at their website, their fact sheet about this income ETF. We're going to go to a drip calculator and see how much money you would have if you had invested when it first started in, I think, 2022. And then we're going to run that full calculation and see exactly how many shares you need. And again, it is pretty wild. So I hope you guys enjoy. If you like stock and ETF content, hit the like button. That helps me out quite a bit, and it tells me if you guys are enjoying these videos. So now let's jump right into it. Starting with the one-year chart for SPYI, we can see that it has been doing pretty well this year, up 8.61%, and that is over the last full year, not year to date. So one thing with ETFs like this is you can't buy them. I mean, you can. I don't. You don't want to buy them and focus on price appreciation, because that's not what they're designed for. They're designed for cash flow. They're designed to send you money every single month. Now, the hard part with this is you don't like to see the price falling over and over and over again, like I said I've seen with other income ETFs. When I had purchased QYLD, I was very hopeful that it would do this for me, that it would pay out consistently every month, and I didn't even need it to go up. I just didn't want it to go down. But unfortunately, when I sold it, it was down about 9%, and I held it for a little over a year. So it was almost breaking even, maybe a little bit positive. But when it comes to SPYI, I purchased it for the 1K dividend account challenge January 2nd, and it's already up 4.54%. Now, this could come down a bit, but as we see, it's been bouncing from this $45 to $50 range quite a bit since its inception, which is about September 2nd, 2022. So it has fallen a little bit lower on a couple points, but then bounced back. What I think is key with this is that 4.5% return I've already made is going to compound with the dividend yield annually, meaning that I already have 4.5% gains, and I'm going to gain another 12% from the dividends. So that's a total return of over 16%, which you're not going to see, or at least I haven't seen, with other income ETFs. Now, anything can happen. This is still a very new fund, and I want that to be noted. I wouldn't just put a ton of money in like I'm going to talk about at the end of the video. You should always diversify, and this is not financial advice, but that's what I like to do. But it is fun seeing funds like this pop up. So now what we're going to do, we're going to look at their dividend history. If you guys are familiar with dividend histories for income ETFs, they are very, very inconsistent. What I like to see is around a pretty good average, not dropping 10, 12% lower every time a new dividend is paid out. So when we're looking at SPYI, we're seeing 49 cents, 46 cents, all the way up to 50 cents a couple times, back down to 40, and we just paid out a 50-cent dividend in February, which was great for my account. And so when we scroll down, we can actually see all the dividend payouts. And yes, I said it's monthly. It is monthly. I love it. I love monthly income. And so we can see what has the lowest been. I see 46 as the lowest so far. So roughly 46 cents is the low, and a high of barely over 50, which we saw once or twice. So the dividend history is really good. And now what I'm going to do is I'm going to show you the difference between this and ticker JEPI. Looking at JEPI, which is the JP Morgan Equity Premium Income ETF, we're looking at their dividend history. So we can see already a lot more variability in the dividend when we compare it to SPYI. Something that is key, though, is this does have more dividend payouts than SPYI, so there is more room for variability. But even if we go to the 1 year, we can see it still jumps around quite a bit. Jumping back to the 3 year, we can see they had a low of 26 cents at one point. Then they went all the way up to 62 cents. And then trailed back down to 29, back up to 43. So when we scroll down, we can see their individual payments. It's monthly as well, of course, but it's a little bit all over the place. And so the problem with this is if you are relying on dividend income to pay your bills, it's going to be hard to do when the dividend is not consistent. That's why I think SPYI has the upper hand over JEPI, even though it has much less of a dividend history. If it can continue to pay out consistent dividends, that would be phenomenal. And of course, you're not going to get the same dividend every time with any of these ETFs because that's not how the options work that they utilize to make their investors money. But it is really important for me to at least have some consistency and not seeing a dividend go down by 50%, up by over 100%, and then back down by 50% again. So I pulled the fact sheet for SPYI from the NEOS website, which I really recommend you guys do. If you're not familiar with looking through data and all this information on the stocks and ETFs that you're purchasing, I really do recommend you get familiar with it. You can learn something new every day and all of a sudden it'll make a lot more sense to you. And this is key when it comes to investing, especially if you want to invest independently. Learning to understand this stuff is so important, and it will just help you overall with your investing experience. So I do recommend that. All this stuff is free. The companies have to show it. You can look on any stock website, go to their investor relations or their portfolio and read through the information yourself. So looking into SPYI, we can see their performance. So their 1 year performance, they're up 20.51%. So they did get outperformed by the S&P 500, which we've seen a boom in the stock market. So I'm not surprised by that. When you're looking at ETFs, again, you're not buying these for that price action. You want these for that dividend that is consistent. So of course, the S&P 500 is going to outperform this when the markets are just super green and super bullish. When you see more of a bear market, you will see more dropping in the S&P 500 than you would for SPYI. That is at least their goal. And so we can see that year to date, a 5.19% dividend yield on the 6 month, 7%, 3 month, 8.1%. And that's just on the NAV. For the market price, all the numbers are here as well. Pretty close, of course. And so scrolling down, we're going to look their distribution frequency for that's when they pay out their dividends is monthly, which we love. Their yield is 12.14%, which is, I think, phenomenal. It is getting so high up there that I get a little bit nervous, but it's not quite there yet. Once it gets into the 15s and 16s, I start getting a little bit nervous. They've paid out about 50 cents a share. That's what they've been paying out. And then their 30-day SEC yield is 0.85. So we can see the price of what they've been paying out in the distribution share percentage. So boom, it's been bouncing around quite a bit. Interesting month for October. But one thing that I think is really, really important, we can see their top 10 holdings: Microsoft, Apple, NVIDIA, Amazon, Meta, Google, Berkshire Hathaway, Google, the different class, Eli Lilly and Co. I'm not familiar with that one. And then Broadcom. But again, there is a ton of information on these. And one thing that's really nice with SPYI is how they run their dividends. So normally you would get taxed a higher rate on dividends that are, I believe it's non-qualified or qualified income. So when it comes to dividend income, before we jump to the drip calculator, I want to point out these key features right here. So for SPYI, they seek high monthly income, we know that, but they have a tax-efficient option strategy and ETF structure. So this is really, really important because if you're not investing in a retirement account, which are tax-free brokerages, which if you don't have a retirement account and you have qualified income, I recommend opening a retirement account. That's not financial advice, but I think they're the best way to invest. But what they do is normally when you are paid out these dividends, you are taxed on them, and it's not a very forgiving rate. You're going to lose a bit of your dividend income to taxes. So they have a tax efficient option strategy, and it's relatively complicated. I'm not going to go into all of the details, but the way that they run these option calls and how they distribute the money, you basically save money on taxes, which I think is really, really important. And it's a great idea for these ETFs that make more money for the investors in the end. And it makes it a more sought after fund. And then another thing is their potential upside equity participation. So like I said earlier, when you compare this to the S&P 500, it hasn't been performing as well because the S&P 500 has more just stocks that it holds. And so boom, when the markets are booming, it does better. Where these ETFs, it's different with the way they run these options. So the nice thing with SPYI is they do have some nice focus on the price appreciation side. So you can still get some participation when the market is running really, really well, when it is a beautiful bull market like we have seen. And so that is something that is really important that helps me look at SPYI and go, oh, they stand out. They care about their investors, and this is what they're trying to do. So now let's jump in and look at that drip calculation. So a quick look at the drip calculation. This is only going to go back to September of 2022. So we're not going to see everything, but we will see a little bit of information. We can see that we knew that the S&P 500 outperformed it. It did really well. We see the 20% to 32, almost 33% that we saw from their own fact sheet. So they're not saying that this is going to make you more money than SPY, or they're not claiming any of that. Their goal is that monthly income. We also see that investing and reinvesting those dividends is actually going to make you more money on a 12.7 return compared to an 11.36. So just something that is important to note. I love compounding and reinvesting my dividends, but when it comes to other people, you may not like that. And so that's where you may just hold SPYI and have dividend income every single month. Now we're going to look at that calculation. So I already said that I do know the magic number, but I want to show you guys if we invested let's see, our starting sum with a 12% dividend rate for just 1 year. That's what we're looking for. How much can we make 1 year if we want that $500 a month? So the total is going to be $50,000. I used just 12%. You're going to make a little bit more of that, but the expense ratio for this, which is important with ETFs, is a little bit high. It's about a 0.6. So a little bit of a higher expense ratio because this is an actively managed fund, but still not too high, not out of my comfort zone. There are some funds that have like a 0.99% ratio, which is really, really quite a bit up there. But still, on $50,000 invested for 1 year at the 12% dividend, you would make $6,000, which equals $5,000 every single month. So the beauty of this, let's say we have $5,000 at a 12% rate, and we do this over a 10-year span for SPYI. At this rate, you are going to make so much money. On the 10th year, your total money is $155,000, which is quite insane for sure. And so the beauty of this is just over time, the compounding effect, the dividends, you can make a serious amount of money. And that's why I do love these. I really, really do love these. And the beauty of this is still just your $50,000 at a 12% rate for 10 years. You're not adding more money at all. What you're doing is every year you're compounding. All the money you made from dividends goes back into the stock, total returns, and boom, you continue to move up. So I really think this is great. Your total returns are $105,000 off of your $50,000 in just 10 years. That is hard to beat in my opinion. Let me know what you guys think down in the comments below, and don't forget to like the video if you found this useful, and I will see you in the next one.